Hello, welcome back. My name is Kurt. I'm a value investor, and today we're going to look at a small stock that I discovered recently. I've included it in some of my other videos, but it's really a stock that presents a great opportunity. Let's dive into the company's financials and see why I think this is such a high expected annual return at the current price using a discounted cash flow analysis and valuation. So let's look at grvy Games. Ticker symbol grvy. And the first thing we want to do is understand, what does this company do? I mean, what are its products? It's a small cap company, $500 million or so. And really, this company is based in Korea. It's based in South Korea. They are a developer and publisher of 17 different games. It all started with Ragnarok Online. That's their flagship game that they've developed, that they make money on, but they've created many different games that are based on that original game that was released back in the year 2000 or something. It's a very long-running online-based game. They've created mobile gaming applications, they have console games, and they've bought and acquired a couple other games that are in a totally different universe, or they're for kids or something like that. So they trade in the US through an ADR. I've been covering a few different ADR companies recently, and sometimes you can just find really good deals when you're working with companies outside the US. However, a company that's trading in the US publicly through an ADR has gone through all of the regulatory requirements, the accounting and the auditing requirements that the SEC mandates. Now, this company makes revenue predominantly in the Asian markets and somewhat in North America, which is US and Canada. But Japan, Korea, Thailand is a big moneymaker for them. And then they have Taiwan, Hong Kong. So those Chinese influenced provinces there are also making up some money, and they're growing in those regions. So the regional breakdown of revenues is very interesting, and we're going to see that it includes a little bit of geopolitical risk and involvement. But I would say that Japan, Korea, Thailand are their three highest user bases, with US and Canada also behind there. So it is somewhat diverse in that sense, but it's a predominantly Asian market for their users, for their games. The price history is shown here, and I think it's just so interesting. I showed this on another video I did recently, how they've had these spikes up and then they collapse down. So it's very cyclical in that sense. Spike up, collapse down. It's spiked up and collapsed down again. So we're near the bottom of this trend. And you can see that if you go from about the top, if you take away the highest spike blow off top and these price movements and just go along the top edge of these support lines on the top end and on the bottom end, you can see we're closer to the bottom, but it's moving its way back up. The stock was priced above $200 a share during the height of COVID, when lots of people were probably playing their games online, and they were probably collecting a lot of revenues and users that way. And by the way this company collects revenues is actually not by charging for the games. A lot of their games are free. They're mobile games, their online Ragnarok game, but they have in-game purchases and they have in-game currency that you can purchase with real currency. And then that in-game currency allows you to do certain things in the game. And that system and that way of making money has been interesting, and they're starting to include things like non-fungible tokens within their games. So when you get people that are really involved in the video game, that they build up entire systems, and then you have tokens within that game and they're interchangeable. So it's a very interesting pricing structure. They make a lot of money on selling those in-game currencies to have better in-game experiences, and so they can really control how their users feel, because the users will always keep coming back for the free game. And then it's like, how do they incorporate those add-ons, and how do they tempt the users to want to buy them based on the circumstance they are in the game and what's being offered. So I think it's a really creative way, and there's a lot of open-ended nature. So it's really down to the management and the decisions that they make about what they're offering. That's going to drive revenue and profit. Now, what's interesting when looking at the price, it crashed all the way down from $200 a share. It's now down to about $78 a share, but it has 2 times the free cash flow that it had back at the height of COVID. And even if you go before the pandemic, back in 2019, they were surging to their price up close to $100 a share, but right now they're at 78. They're making a lot more free cash flow than they were back then. So it's all about the growth prospects and the investor sentiment going up and down with this company. Here's a look at the revenue. You can see in the last couple years, the last year or so, it's really gone sharply up after somewhat of a stalling, declining revenue there. So the long-term trend, you can see why the price has really spiked up, because there's been these intense growth periods. First back in 2018, 2019, now recently. And when you annualize this over 10 years, 5 years, 3 years, you can see huge growth numbers. And so where is that going to go into the future? I don't anticipate having 63% annual growth necessarily going forward, but it seems like they've really developed a good following of users that they're able to convert into sales and into profit. Let's see their profit, by the way. And this is why I love companies that are really small, that have consistent long-term growing profit. It's not just about revenue, guys, not just about sales. Look at what's happening with their profit and free cash flow. Yes, they've had some trouble in the past. They've been a little bit cyclical with their profit, and that reflects their price surging and then coming back down these 3 times. Right now, it should be surging again, but it really hasn't come anywhere close. It hasn't crossed that $100 a share threshold. So I foresee the market really catching up with this going forward. I guess the market is anticipating their earnings to fall back down again. But even if they were to fall back down, look at the long-term trend here. It's very positive, 32% per year over the last 10 years, and it's just been really high in the intermediate periods. Looking at their free cash flow on an annual level, this company is so small that it's tough to get accurate reporting and pulling it all in because the big platforms like Macro Trends doesn't have the best information on it. But I was able to pull in their free cash flow on an annual basis, including the most recent year. It was an estimate based on their first 3 quarters plus that Q4 operating income percent change over the previous year. So I kind of implied that. But wow, they're up to over $100 million in free cash flow. Whereas remember I was saying that they've been at $200 a share before in 2021, but their free cash flow was a lot lower. And if you look at 2020, they were at $55 million free cash flow. So that free cash flow growth is really powerful. To me, it looks like this company knows what they're doing to grow free cash flow. The 9-year growth trend annualized is 11% per year. And the 5-year trend is 27% per year. So they're accelerating that growth, and it looks pretty good to me as far as free cash flow is concerned. Return on invested capital, you can see the 10% line there. It's really fluctuated. It's a small company, so it's kind of tough to measure things like return on invested capital. So I'm going to give them the benefit of the doubt on that. We'd like to see above 10%. If it's a company in that tech space, we'd like to see 20% or higher. So it's lived in that region. Now, as I go on to their balance sheet, one thing I should note is that I didn't include shares outstanding in this presentation because their shares outstanding has been, I think, 6.95 million shares going back to 2009. So they have not increased or decreased shares at all over a long, long period of time. So I kind of included no change in their shares outstanding going into the future because they've shown that that's not the business they're in. They're not going to issue new shares and they're not going to buy back shares. They're just going to drive growth, and they're doing it very organically without raising capital through issuing shares, which is great. So looking at their balance sheet, you can see they have $330 million of cash on hand, which is most of their current assets. They also have only $8 million in property, plant, and equipment, $4 million in intangibles. So $420 million in total assets. They do have $86 million in debt, but with $300 million in cash on hand, I mean, that's nothing. I mean, so they have basically no debt, which is amazing. I don't have to worry about this company going bankrupt or broke or anything. And they have cash to deploy. Let's say they have some struggles driving sales and profit. They can deploy their cash in marketing and retain those customers and get more customers back. So with $90 million in liabilities, $400 million in cash, their book value is about $330 million. I did a little adjustment, of course, like we usually do, 30% of inventory taken off, 50% of intangibles, 20% of property, plant, and equipment, which those don't account to much. So they have an adjusted book value of $325 million, which is a per share value of $47 a share. So when the company's $70 a share, $80 a share, well, $47 of that is just the value of the cash that's sitting on their balance sheet, the value of the business itself without any of the future free cash flow. It's just the liquidation value of the company. So, I mean, that's starting from a really high base. So let's see where the free cash flow gives, but that's a really great characteristic of this company and one of the reasons I love it so much. When we look at their pillars, you saw in their revenue long-term, you saw in their profit long-term, you saw in their free cash flow long-term, they grow consistently. They have been growing. Their valuation metrics are superb. Right now, they have a 1-year trailing price to earnings ratio of 5. 5. And their return on invested capital is really high. It depends on what metric you exactly pull for that, since it's such a small company, but they don't issue dividends, and so we don't have to worry about that. Revenue's consistent, net income's fairly consistent, shares outstanding, they don't dilute at all, so awesome. Debt, we just looked at their balance sheet, perfect. Free cash flow growing. So this is a very fundamentally sound company. They're consistently growing, and they're growing rather quickly. And their valuation is so low. So what can we say about the company other than this is amazing? 8 out of 8 pillars, 20 out of 21 sub-pillars. And with so much cash on their balance sheet, there's very little risk of this company having really terrible times ahead. Now, their free cash flow could fall off, but they have so much cash on the balance sheet that they have the ability to do something about it. Now, there is a little bit of geopolitical risk, so we have to take that into account, into mind, but the powerful trend in the growing free cash flow with low capital expense needs, I mean, it's an online game. They don't have to build new things or build new factories or anything. Everything's happening on the cloud at this point, and so their ability to deploy capital to grow is really high. So let's get into the valuation, the discounted cash flow model. I went ahead and assumed a base year free cash flow of $65 million, which is a lot lower than where they currently stand, above $100 million, I think, just above $100 million in the last year. But if you go back the last 2 years, so let's say they've surged, right? And let's just assume, hey, let's assume they have a little bit of a down year going forward. The year they currently had isn't representative of where they're going to be in the future. It's an abnormally high year. So if we come down and we say, let's cut it down to 65 million, just use that as an assumption, then we have a really high confidence of what we're projecting is going to be at least on the low side. Now, you could say, no, they're going to drop down to 40 million. Well, okay, then plug that in as an assumption, and we'll do a lower assumption in a minute just to see what that would look like. As far as growth, we saw numbers there, 30%, 25% per year over the last 10 years. Now, the free cash flow is a little bit lower, but I'm going to go ahead and assume 16% per year over the next 5 years. They are starting to get into mobile gaming. They're starting to get into the Chinese market, which could be lucrative. I think those mobile games are going to do really well. People download the mobile games, and then there's a really low resistance when you're playing those games to spend $2 on something, $5 on something. That exposure through the mobile gaming system, I think, is going to drive their revenue and their earnings higher. It's going to be low margins. I think it's going to do well. And so I think that's a really low estimate. I mean, it could be a lot higher than 16%. But if I'm being conservative and saying, yeah, I think this company's growing really well, and from here, I think they can grow further. 5% is what I'm going to use for my 5 to 20 year range, that medium term growth range. I think the company will start to slow down its growth, and 20 years from now, basically we're going to set the perpetual growth to -3%. I think the company will die out eventually. I mean, I don't think this company is going to live forever. It could, but I don't know. It's survived a long time since the beginning of online gaming, but -3% perpetual growth for companies that are smaller that we don't anticipate being around in, let's say, 50, 70, 100 years. Margin of safety, I'm going to apply 30% because the company is so fundamentally sound on our pillars. However, instead of giving it a 20% or 15% discount, which is what I would do for a really fundamentally sound company, I'm going to stick with the 30%, which is what I typically use, because there are some risks to the company being smaller, having a smaller market cap, and some of the geopolitical risks involved. So 30% is going to make me feel comfortable on the margin of safety. And with all of those assumptions, I anticipate a 30% expected return at the current price. And that's the current price I'm looking at is about $78. Depending on when I post this video, price might be different. Now, at each of these discount rates, I show a 10% discount rate at $200 a share. That's kind of where they were when they peaked out a couple of years ago. For a 15% discount rate, $135 a share, 20% discount rate, over $100 a share. So from this perspective, so from where we are now, under $80 a share, I think there's a lot of room for good returns to buy this thing all the way up to under $100 a share. Even 25% at $90 a share. So as long as it's under $90 a share, I think this is a great buy. And I think those are fairly conservative assumptions. Let me know what you think about those assumptions down below. I'm going to look at a lower valuation. So I'm going to set the base year free cash flow to 50 million instead of 65. and grow it at 10% next 5 years, 2% the 15 years following that, with a perpetual growth of -4%. So it'll get closer to zero a lot quicker. A margin of safety of 35% to account for more uncertainty, maybe a drop off in free cash flow growth sooner. And so that will give me an expected return of 17%, which I think is really high. I mean, for such a pessimistic outlook. And again, the current price right now is 78, and using these assumptions, somewhere between 15 and 20% would be the expected return. And you're looking at $83 a share for 15% return, or an equivalent discount rate that would balance the free cash flow there with the current price with the future free cash flow. A 10% discount rate is over $100 a share. So I really see this thing being something that should be trading up above $100 a share, up to $200 a share even, depending on your assumptions. But as pessimistic as we can look, this thing is still a great return. It's still fundamentally sound on the pillars. So in summary, the question you have to ask yourself is, are you willing to take a risk on such a small company? $500 million market cap, it's a potentially big reward because this company is not covered by analysts. Nobody's looking at this company. I'm thankful that there were some people on social media that I was able to find this company. And so it's a potentially big reward at this price. But do you want to take a risk on a company that's so small and is kind of obscure? The fundamentals, they give me confidence, especially that balance sheet and that cash they have on hand. But it depends on the outlook of gaming, mobile gaming, and especially what's happening in those Asian markets. Any conflict in the region with China especially could shake things up a little bit, make things a little tougher for them, make the sentiment go down. So I'm willing to ignore those those concerns because of the solid nature of the company and how long it's been around, since 2000. And they've been growing. They've shown in the last few years they can really grow the company well. So I'm going to certainly be buying this company under $90. I've already taken a position, full disclosure. My sell target is at least $140. I mean, I might keep this thing, but let's ride it. It has a good technical pattern right now too. I mean, the thing's going to be trading up, it seems like, unless there's a material difference in their financials. So my overall rating, and by the way, just because I own the stock and just because I have these buy targets and sell targets, that doesn't mean that you should do just what I do. Use your own due diligence, do your own assumptions, read their annual report yourself, and plug in your own assumptions and see what the mathematics tell you and whether it fits your investing goals. Because for me, I'm willing to take the risk on this to get the returns that I expect based on the assumptions given the fundamentals. But you have to do that risk assessment for yourself. My overall value rating for the company, though, using my own system, is 10 out of 10. And that is the third highest company right now. Prices are always changing and valuations are always changing quarter to quarter. But right now, it's the third highest on my list out of all 300 companies that I've evaluated. So 10 out of 10. I only have 3 stocks that are rated 10 out of 10. And I only have a small collection of stocks that are rated 8 or 9 out of 10. But this one is a 10 out of 10. Given everything combined, such high expected returns. That's what I've found for Gravity Gaming, GRVY. So check it out. And if this video has helped you, I really appreciate it if you subscribe. And if you click the like button, go ahead and watch another one of my videos if you'd like to learn more about value investing and using a discounted cash flow analysis to come up with intrinsic fair value. Thank you guys for watching. Best of luck investing, and I'll see you on the next one. Take care.